Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh and very good afternoon everyone. So let's continue our discussion on financial management. Today we're going to discuss the interest rate and bond valuation topic. So before we continue, let me summarize a bit on the topics related to time value of money, the part 1 and part 2. As you know, last 2 weeks we have discussed the topic related to time value of money. So first, in 2 weeks ago, we talked about the roles of time value of money. So remember, time value of money is a tools that we can use in order to make decision at one single period. Because remember, normally we are facing with many different type of cash flow and investment opportunity, and the amount are different at different time. So time value of money allow you to convert at one single period, either at present value or at future value. So we have discussed that last 2 weeks, and we talk about three different pattern or basic pattern of cash flow, namely the single amount, annuity, and midstream. We have learned on how to calculate the future value and present value of each of them. So remember, for future value, we always use the compound interest unless it's mentioned, right? And annuity, there are three different types of annuity: ordinary, due, and perpetuity. And finally, for the unequal predict cash flow, we have to use the midstream methods. Yeah, you have to calculate one by one, or you can use your financial tools like financial calculator, Excel, or many apps that can help you to speed up the calculation. That's the time value of money part 1. And part 2, we have the asynchronous lecture. So I hope that you can understand the discussion that we have. If not, please ask question. So first part of the topic is on the compounding interest more frequently than annually. Because not all the time the interest is compounded annually. Sometimes the interest you receive is every 6 months, semi-annually, or every 3 months, quarterly. Every month, remember that sometimes you take loan and then they will charge you interest every month, so that's monthly, or it can either be continuously. So we have learned on how to calculate the future value and present value for the single amount, the annuity, and the mixed stream when the interest rate is compounded more than once in a year. So the reason why the future value of the interest rate that compounded more than once in a year is higher compared to the interest rate that compounded annually, because of the higher effective annual rate than the nominal rate. So in last week also, the discussion was on the difference between the nominal rate, the rate that given to you, and the actual rate that you receive, that we call as the effective annual rate. Yeah. When the interest rate is compounded more than once in a year, the effective annual rate will be higher than the nominal rate. We have learned on how to calculate the EAR last week. And after that, we talk about fractional time period, and when the periods are not the same, not exactly 1 month or not exactly 1 year. Based on the earlier discussion, when how to calculate the future value for the interest rate that compounded more frequently than annually, we can use that too for fractional time period. Yeah. And after that, the discussion talk about the loan amortization. Yeah, this is very practical example. When normally we go to the bank and we take financing or loan, so first we need to know how much we have to pay every period, every month or every year. So from the amount that we pay, how much actually goes for the interest or profit portion, and how much you actually pay the principal of the money that you borrow. For example, like if you borrow 100,000, you may need to you may need to pay more than that, says like 150,000. So the monthly payment that you make at the beginning, so the bigger portion will go to the interest or the profit part. Only small portion will pay the principal of your loan or financing, right? So when the time get longer and longer, so the proportion of the principal payment will be greater than the interest payment. Because remember, the interest is charged based on the balance of your loan or financing. Yeah. So that's basically loan amortization. And finally, for last week lecture, the discussion was on finding the growth rate or finding return on your investment, as well as the period for your investment. That's basically the lecture on the part 2 of time value of money. So from today onward, we're going to start discuss on how to apply the concept to make the decision of financing and investment decision. So these are the concepts that used by the financial manager to make the decision. So before we continue, any question in regard to last week lecture or any question that you want to ask? Yeah.
Doctor, just now
Yes.
I scanned the QR code in the Spectrum, but it
Mm.
it cannot be
Sorry,
scanned.
that one is for, I think I didn't change. That one is for the 11 a.m. Can you download the PDF file first? Let me change it now.
Oh, okay. Thank you, Doctor.
If you cannot scan, sometimes I forget to uh, change the QR code from the morning session. Yeah. You can download the PDF file that I shared in the week 6. Yeah. Wait, Okay, already changed now. Okay, thank you. Any other question? Yeah, as I mentioned, Wang Liang, that one is for the morning session. If you cannot scan the one that in the Spectrum, please download the PDF file. So from there, you can scan your 3 p.m. class QR code. Is it okay? Mm.
Yes, thank you, Doctor.
Okay. Any other question? Mm. So if no question, I assume that everything clear for the last week lecture. So before we continue today lecture, I just want to actually summarize and then show you the skeleton of our financial management class, all right? I mean the framework. So as you see from lecture 1 until lecture 5, we started with the lecture 1 that introduced you to the managerial finance and the role of managerial finance, what's the difference between finance, economics and accounting, and we also talk about the system, the financial system that basically link between the deficit and the surplus unit. On the lecture 2, we actually analyze and learn how to analyze the financial statement from finance perspective. Lecture 3, we talk about cash flow from the financial perspective, and then we talk about financial planning, and we basically discuss on how to plan for the company cash as well as for the company profit and the balance sheet. And last 2 weeks, as I explained just now, we talk about the tools that we can use to make financial decision, or we call it as a time value of money. That's basically the background for the financial management or corporate finance. From lecture 6 onward, we're going to apply the knowledge that we have learned and to understand how the financial manager make decision. As you can see, this is the balance sheet, and the balance sheet have the asset, which is the investment decision, and liability and equities, the financing decision that the company have to make. So from asset side, we have current asset and long-term asset or fixed asset. From the liability and equity, we have current liability, long-term liability and equity. So for today's lecture, we need to learn on how to value the long-term liability, which is representing by bond. Yeah, bond is a debt, long-term debt financing. I mean, when the company want to raise the capital through debt, they can issue bond. So therefore, for today's lecture, we're going to talk on how to value the bond. So why it is important to know the value? Yeah, of course it is important. Because if you don't know how to value anything, so it's hard for you to decide whether the price offered to you is the reasonable price or the correct price or not, right? For example, like if you go to the shop, you have no idea about what is the price of that item should be, right? So then it's very difficult for you to judge whether the seller offer you the reasonable price, the correct price, or they try to take advantage of you. So we don't want to overpay when we want to invest in something. Similarly, that's very important for you to understand on how the company value the bond. Similarly for investors, the same. Yeah. Investors and the company. The company want to raise the capital and the investor want to invest in bond. So both of them need to know how the bond is valued. So that's in lecture 6. Yeah. Next week, lecture 7, we're going to talk about equity valuation or stock valuation. What are the concepts used to value the stock? Same objective is to know, how the equities is evaluated. To know the right value of the equities. So we need to know what are the formula or the concept used to value the equities. So both from the company and the investor's point of view. Okay, from lecture 8 onward, that will be Dr. Fauzi will take over the course. So he'll continue discuss the introduction to risk and return. Remember, when you raise the capital as a company, you need to pay the return for your investors, right? So investors for your the what you call the return for investors mean cost for the company. So the return from the investor's perspective is the cost from the company is considered risk. Whether you can pay back the money to your investors or not. That's a risk. And then you want to decide on the return. When you meant to make investment, right? How much return that you can generate. So you're going to learn the relationship between risk and return in lecture 8. Yeah. Things still related to financing and investment decision. Okay, on lecture 9, you're going to talk about cost of capital. Yeah. So of course, if you want to sell something, you need to know the cost. Like if you want to sell coconut rice or nasi lemak. So before you decide on the price, you need to know how much the cost to produce that nasi lemak. So, for example, like after you calculated everything, the cost to produce the nasi lemak is 1 ringgit. So you definitely need to sell the nasi lemak or the coconut rice more than 1 ringgit, 2 ringgit or 2 ringgit and 50 cents. Why? Because you need to get profit from the business. Yeah, you cannot sell less than 1 ringgit. Because the cost to produce is 1 ringgit, you should sell more than 1 ringgit. So that's why it's very important to know the cost before you can set up the price. Similarly, for the company, they need to know when they raise the capital, what is actually the cost. Because remember, when you borrow money from the bank, it's not free. The bank will charge you interest. Similarly, for the investors, they give you the capital, they want the dividend. So the interest and the dividend, both of them are costs from the company perspective. So we will learn on how to calculate the cost of capital in lecture 9. So after that, lecture 10 and 11 will actually guide you on how the company make investment decision. After you know the cost, then you can decide whether to invest or not to invest. You only invest if the investment give you return more than the cost. Like what I mentioned just now, you can only sell the nasi lemak more than 1 ringgit. Yeah. You cannot sell less than 1 ringgit, otherwise you will suffer losses. Yeah. Similarly, for the company, after they know the cost, they can decide whether this is a good or bad investment. Good investment are the investment that can give return more than the cost. Bad investment is the investment that give return less than the cost. So then you can make decision whether to invest or not to invest. So what are the techniques that we can use to make the decision? That in lecture 10 and lecture 11. Okay, as you can see from the gray boxes, right? The long-term fixed asset, the long-term liabilities, and then the equities. They're all the long-term financing decision and investment decision. We call it as a strategic financing decision and strategic investment decision that you plan for your long term. And after that, you need to make sure that after you have strategized your long-term financing and investment, you need to make sure that your operation, the short-term asset and liabilities are also well managed. So therefore, in lecture 12, we're going to talk about how to actually manage your working capital and current asset. And lecture 13 will continue the discussion on current liability management. And then we finish the introduction of financial management or the financial management. So basically, from lecture 1 until lecture 5, we talk about the background, the tools that you need, and the concept before we continue to learn on how the financial managers make financing and investment decision. The first part on the strategic, and then the second part, the last one, is on the operational financing and investment decision. So that's basically the financial management. Okay. Any question? So that will guide you. You see that in how the discussion on our financial management from today onwards, right, related to the company balance sheet, the financing decision and investment decision. Any question?
No, doctor.
Okay. So let's continue. For today, we're going to talk about interest rate and bond valuation. Remember, bond is a long-term debt instrument. So we want to know how to value the bond. When it comes to debt, I mean, how do we price the debt is based on the interest rate. So that's why the first part of the discussion will be on how to understand the interest rate. We're going to start with interest rate fundamental, nominal rate, the real rate, and the inflation, and what are the term structure of the interest rate, and what are the theories that can explain the structure of the interest rate. And the second part of the discussion on the corporate bond. Yeah, we're going to talk about the features of the corporate bond and how to value the corporate bonds. That's basically our discussion today. Yeah. So it's quite technical. And then if you, the most important one is the last one, the bond valuation. We need to know on how to value the bond. But however, before that, you still need to understand the concept, because after this is the basic, right? So from, if you plan to take any finance courses after this, so this knowledge they expect you to know already. So that's why if you're not clear, if you don't understand, please ask me to actually explain again. Yeah, but I try to go quite fast for the point number 1 until 4, and we're going to focus more on point number 5. Yeah. So this basically the learning goals where you can read by yourself. It's almost the same thing with the summary that I show you just now. Interest rate and required return. The interest rate fundamentals. The interest rate is usually applied to debt instruments such as bank loan or bond. The compensation paid by the borrower or fund to the lender, from the borrower point of view, the cost of borrowing fund. And the required return is usually applied to equity instruments such as common stock, the cost of fund obtained by selling and ownership interest. Yeah, here they highlight the two different between the interest rate and required return. Interest rate is for debt instrument. It's for the fund that you borrow. So the cost is the interest rate, or the return is the interest rate. However, if you are into invest in equity, so you call it as a required return, because interest rate is the obligation for the company to pay, but the required return is something that you can only expect, which is not guaranteed. Yeah, because you part of the owner of the company. Only when you get more, you will get higher return. If less, you will get lower return. But the investors can always require a certain amount of return from the investment. If not, you can always go and find some other companies. Right? That's basically the difference between debt and equity financing. Several factors that can influence the equilibrium interest rate are the inflation, risk, and liquidity preference. So you know what is the inflation? It's the rising trend of the prices of the most goods and services. Risk, because different investment have different risks. Similarly, different people or different institutions have different risks. Just have two persons, right? A and B. Both of them want to borrow money, 50,000 from the bank. So it's not all the time the bank will actually charge the same amount of interest. So it'll depend on the credit score of the borrower, right? If your credit score is low, so that means you are a low risk borrower, so the bank will charge less, say like 2%. The second borrower, actually the credit scoring is slightly higher, and then the bank charge 3%, although the amount both of them borrow are the same, which is 50,000. So that consider risk. Higher risk will be compensated with a higher interest rate or higher return. The third one is a liquidity preference. Just go to the bank, you see the different rate that the bank offer. If you see that there's 3-month fixed deposit, 6-month fixed deposit, and 1-year fixed deposit, right? So the the return are not the same. So the one with the longest period, the 1-year return is higher than the 3 months, right? Because of the liquidity preference. What's meant by liquidity preference? For 1 year, you have to wait for 1 year until you can get the cash. But for the 3 months, you just have to wait very little amount, which is only 3 months. Then you can withdraw the money. So the most liquid one, probably the deposit, right? Like you can withdraw anytime. So that's why the return is very low. So that's what influenced the interest rate. So the real interest rate is the rate that creates equilibrium between supply of saving and the demand of investment. In a perfect world without inflation, where suppliers and demanders of funds have no liquidity preference and there is no risk. The real rate of interest change with changing economic condition, taste, preference, and the supply-demand relationship that determine the real rate is shown in the next figure. You see that when the supply and demand of fund, more the supply of fund, the rate will be lower. Less the supply, the rate will be higher. Similarly, the demand, more the demand, the rate will be higher. Less the demand, the rate will be lower. So this is the real rate of return. So we will see what's meant by real rate of return after this. So first we have to understand what is the nominal rate of interest. Is the actual rate of interest charged by the supplier. Remember last lecture we talked about the nominal and the effective annual rate. So the nominal and the last week lecture is the same meaning. So mean the rate that offered by the bank. But the actual and the effective annual rate are different. Here we want to talk about the actual rate that you earn. Yeah. That one is the effective annual rate. So this is the actual rate that you earn that will determine the rate of the interest. So you see that the nominal rate differs from the real rate of interest as a result of two factors, inflation and then the risk premium. So this is basically R1 is nominal, the rate offered by the bank. So what are the factors that influence the high or low of R1, the nominal? So there are many different factors. The first one is the real rate of return, the R with the asterisk, plus inflation, plus risk premium. Yeah. The real plus inflation is the risk-free RF. So if you don't want to take any risk in your investment, so you just put the money in the government securities, which is the government guaranteed that you will get back your money. However, you not get very high return. Why? You only get the real and the inflation. But for those who want to invest in other than the government securities, which is the risky investment, so you will be compensated with a higher interest rate. Why? Because you're willing to take the risk premium. So that's why the nominal and the real are not the same. Because remember R1 and R asterisk. This is the nominal, the rate that offered to you. The R asterisk is the real return that you will get plus inflation plus the risk premium. So that's why nominal and real are not the same rate. Yeah, because the nominal already considered the inflation premium and the risk premium in it. So at the moment, just concentrate on the risk-free rate, RF. The risk-free equal to the real plus inflation, right? So look at on this example. Marilyn Carbo has $10 and then would like to spend on a candy that costs her 25 cents per piece. At the moment, she can actually buy 40 pieces of candy with $10 and 25 cents. But if she decided to invest the money and get the return of 7%, the risk-free return, at that time is 7%. And then, however, the inflation is expected to be 4%. So look at that. When she actually decide to invest the money and get 7% after 1 year, whether her purchasing power increased by 7% or not. The cost of the candy will also increase by 4% because of the inflation. So after 1 year, the candy cost will increase to 26 cents. And she will earn $10.70 because she gets 7% return from her investment. So how many pieces of candy that she can buy after 1 year? 41.2 pieces. So 41.2 pieces mean 3% increase in the purchasing power. That we call as a real rate of return. Real rate of return is the how much the investment increase your purchasing power. Right? Like in this case, your return is 7%, but your purchasing power did not increase by 7%, but just 3%. Why? Because the inflation is 4%. You see that RF is 7%, R is 3%, IP is 4%. So RF is actually real plus inflation. 3 plus 4, 7%. In some cases, you see that the inflation is more than the nominal. Like in this case. Today, if she buy a candy, she can buy a candy at 40 pieces with $10 because 25 cents. If she invests the money, 7% return. However, the inflation is pretty high on that year, 10%. You see what will happen? The candy cost will increase from 25 cents to 27.5 cents. So, by how much the purchasing power increase? It's not increased, but yet drop. From 40 pieces of candy, after 1 year, she can only buy 38.9 pieces of candy. So her purchasing power dropped by 3%. Yeah. So the nominal is 7%, like in this case, sorry. Yeah. The inflation is 10%. So what is the real rate of return? It's negative 3%. You see that when the interest rate cannot compensate the inflation, so your real rate of return will be negative. Yeah. So that's basically the concept of the actual or the real rate of return from your investment. So that's why the country with very high inflation rate, so although sometimes the bank offer very high return or interest in the investment or deposit, but yet still cannot compensate the real return, because they still lose the purchasing power. Yeah. Okay, any question? Yeah, this is an example of the reality, right? On the most efficient capital market, which is in the US. You see, not all the time the rate offer can compensate the inflation. Even in the US, yeah, in some situation, you see that the red shaded one, yeah, the negative real interest rate, also happen, where the rate offered by the Federal Reserve, right, the government, still cannot compensate the inflation of the country. Yeah. Okay.
Okay, doctor.
Okay. So that's basically the first and the second one, right? We talk about the interest rate fundamental, the nominal rate, the real rate, and the inflation. Remember, the risk-free consists of inflation and the real return. But if you want to invest other than the risk-free investment, you'll be compensated with the risk premium. So you should expect to get higher return than the risk-free. Now we're going to talk about the term structure. It's a yield curve. The term structure of interest is the relationship between the maturity and rate of return for bond with similar level of risk. Yeah. Bond with the same risk but different maturity. And then what will be the rate of return? Yeah. So just imagine 2 years bond and 10 years bond. Which one will give you higher return? 2 years or 10 years? Why?
10.
10. Why? Chong Lizin?
Because the money will be kept for very long time and we cannot use the money. So the interest rate need to compensate this.
Yeah, because higher risk, right? Less liquid for the 10 years compared to 2 years. Yeah, the 2 years you just have to wait for 2 years and then you can immediately get back your money. But if you invest in the government securities for 10 years, so you will be compensated with the maturity risk premium. Because you have to wait for a longer time, you should expect higher return from your investment. So what is the yield curve? The yield curve will be the 2 years bond return will be lower and then the 10 years bond return will be higher, right? Yeah. So that we call as a normal yield curve, upward sloping yield curve. Yeah. Like in this case, May 2017 and the February 2002, which is the 2 years or the 5 years yield to maturity or the return. Yield to maturity is the return, is actually lower than the 30 years or the 10 years, right? So the shorter one is lower, the higher, the longer one is higher in terms of return. However, in some circumstances, the market show the inverted yield curve. You see for February 2007, the short-term rate is about 5%, 4%, more than 5%, and then the long-term one is lower. Is the inverted yield curve, yeah, in February 2007, where the short-term yield or required return is actually higher than the long-term yield or required return. Yeah. Or a flat yield curve. You see in July 2006, it's almost the same between the short or the long-term bond. This is a government bond, right? Yeah. So we take from the US. Yeah. Why? The risks are the same because they're all issued by US government. The only difference is the time to maturity. Yeah. Logically, the short-term one should have lower return than the long-term one. But why in some events, the long-term one has lower required return or yield to maturity than the short-term one? Then come many different theories to explain, right? Yeah. This is the same example. Why sometimes inverted, sometimes upward sloping. So as you can see, there are 3 main theories that explain the situation. The first one is the expectation theory. As you can see, the term structure, right? Point number 3. The second point, the expectation theory. Expectation theory explain about the normal yield curve. That's normal. Because for the long-term one, they should expect to get higher return than the short-term one. And similarly, the expectation theory say that why there is inverted yield curve, because people expect that the interest rate will drop in the future. So because of that expectation, right? So the long-term interest rate offered are actually lower than the short-term one. And similarly for the flat yield curve, because they assume that not big difference between the current interest rate and the future interest rate. So that's why the market shows that the yield curve are more or less the same between the short-term investment and the long-term investment. That's the first theory that explains the behavior. First, you have to understand, right? This how we get this curve. Yeah, the line is from the historical information. I mean, from the, you see the link given to you at the bottom. So this is the one rate offered by the US government based on that particular month and year, right? So it's just historical rate, and then they take the rate and they put sales like in the Excel, and then they can show you the trend. Yeah, because at one time, most of the time is always like May 2017 and February 2002 lah, the normal yield curve. But some circumstances like in February 2007 and July 2006, yeah, so the yield curve are slightly different than the normal. Yeah, because of that. How they explain, the researcher lah, in people make research and they explain. First, they develop the expectation theory. So yeah, the future, the yield curve will be based on the future expectation about the interest rate. The second one is liquidity preference theory. This theory explained that the short-term one should always have lower rate than the long-term one because of the liquidity preference. Which one is more liquid? The short-term ones. Therefore, they should have lower yield or lower rate than the long-term one. So, however, this theory cannot explain why in the market they have the inverted yield curve and the flat yield curve. Yeah. And the last one is the market segmentation theory. So the market segmentation theory basically explain that the rate of the short term and the long term will be based on the demand and supply. Yeah. For example, like if the short term is more demanded than the long term one, right? Yeah. So then it will be more expensive and higher than the long term one. So it's based on the market demand, whether market prefer to have the short term bond or they prefer to have the long term bond. Yeah. So that's basically the market segmentation theory. So that also can explain why there are different type of the yield curve in the market. Yeah. Either because of the expectation or because of the demand and supply that cause the different behavior of the interest rate than the normal. So that's basically the yield curve. Any question? This you can read by yourself, no? The example, right? So I just summarized the explanation. Any question? So,
no question.
Okay, no question. Let's look at this example. The risk premium. Remember, on the bottom right, you see R1 equal to R asterisk plus inflation premium plus risk premium. This we have discussed earlier, right? What determines the nominal interest rate? The R1 is the real, the inflation, and the risk premium. Okay, this again the data the textbook took from the US market. You see, it's best to take example of the most efficient market, because that can we develop the theory. You know? Because when there is an anomaly, something that unusual, right? Actually, for the inefficient market, it's hard to develop the theory because why? It's not consistent, yeah, in terms of the behavior of the rate, of the prices, right? So sometimes because of the manipulation, so it's hard to develop the theory from there. So that's why they take example of the most efficient one is the US. You see that the 5 years US Treasury note. If you want to buy the US bond, the government bond for 5 years, so you see the interest rate offered to you is only 1.81%. Very low, right? Yeah. So I just checked the Malaysian, I think now lah, the current 2021. Yeah, it's about the same rate, right? Yeah, for 5 years. And then, however, because remember the 1.81 is a risk-free. Yeah, it's a government bond where the government will pay you back your money after 5 years. But every year you will get 1.81% return. It's almost no risk. Your money is almost guaranteed. You just have to wait for 5 years. However, if you don't want to invest in the government bond, you can choose a corporate bond. So corporate bond is no longer risk-free investment because remember corporation, right? They can always fall into bankruptcy anytime. So there is a risk. If you buy the corporate bond, there is always risk higher than the government. So therefore, you'll be compensated with the extra interest rate or extra return if you decide to invest in a corporate bond. And corporate bond have many different types of bond, from the investment grade, the high quality bond, to the speculative bond. What's meant by the high quality bond? High quality bond because the company that offer the bond is financially strong. So normally they are capable to pay back your money after maturity, right? So that's why, because the risk is low, so you'll be compensated with the lower risk premium. You see at the bottom, 3.37 minus 1.81. So you are offered slightly higher than the government. It's only 1.56%. However, if you want more return, you can invest in the speculative bond. What's meant by speculative? If, for example, a company that may face financial issue or financial problem, right? And they need money to borrow. Yeah. So because people know that the company are facing financial issue, there is a risk that you may lose all your money in. So in order to attract the investors, the company have to actually promise higher rate of return. So in this case, the high yield bond offer 5.86% more than the risk-free investment. So to compensate the return, the risk taken by you. You just imagine, you see, even if you invest in the speculative bond, you can only get 7.67% a year. Yeah. What is 7.67% a year? If you have 1,000, right? Yeah. You only get 1,076 ringgit and 70 cents after 1 year if you buy the speculative bond. So that's why if someone come and tell you, give me 1,000, after 1 month, you will get 1,100. So after 1 year, you will get 2,200, I mean 100 every year. What is the return of your investment? 10% per month, not per year, right? So mean 120% per year. That's ridiculous, right? That's why you have to be careful. If someone come to you, say that, okay, I want to give you 10% return in a month. Yeah, that definitely is not actually, it's probably a scam, right? Yeah. So just imagine that if you invest in the high speculative bond, you can only get 7.67%. So either that's a scam or that will be very high risk investment. If someone come to you and say that I will offer you 10% in a month, right? Because after you have the knowledge, you can differentiate whether this is kind of like a logical offer or not. Because if you just want to invest in the government bond, you should get less than 2% a year, right? Not a month. Yeah. So that's why be careful when you take any financing, especially the credit card, because they may charge you 1% a month. So 1% a month is 12% a year, right? Yeah. Even you invest in the high yield speculative bond, you can't even reach 12%. It's only 7.67%, right? Yeah. So that's the thing that you have to consider when you want to decide on investment or someone offer you any investment. Okay, question, Fairuz.
Hi, Doctor. Sorry for interrupt.
Hi, no problem.
Actually, may I know what is the difference between the table, the blue table and the grey table?
Oh, the blue one is the rate offered, right? And then the gray or the green one, the light green one is the risk premium. You see from the equation, right? R1 equal to R star plus inflation premium. R star plus inflation premium is 1.81.
Oh,
And then
okay.
1.56 is the risk premium for investment grade. And then 5.86 is the risk premium for high yield speculative bond. Yeah. Is that okay? Clear, Virus?
Yes, doctor. And my last question is,
Okay.
why government bonds usually low risk than the corporate bond?
Okay, thank you for your question. Yes, of course, because the government can guarantee you to return back the money to you. For example, like if you invest in government, right? So your money is guaranteed by them because they print out the money. Yeah, even if they don't have money, they'll print out the money and give it back to you. So almost no risk. But if you invest in a company, say like what? In Axiata, all right? Yeah, you don't know that after 5 years, Axiata may fall into bankruptcy, right? So if the company bankrupt, you definitely not get back your money, right? So there is a higher risk. Although Axiata is very big and stable company, but there is always risk. They may close down, not like the government, right? So the government never close down unless the country closed down. So that's mean everyone already in problem. Yeah. So that's why the government offer you the lowest rate because the lowest risk. Yeah. The last person to default is the government. Is it okay, Fairuz, or still not clear?
Yes, now clear. Thank you, doctor.
Oh, no problem. Thank you for your question. Any other one?
If the how if the country is nearly bankrupt, then even for the treasurer notes also will we will not able to collect the interest rate if
Yeah.
the country is
Yes.
bankrupt.
Yes. Yeah. Thank you, John. Yes. Yeah. When the company is about to bankrupt, no one want to buy their bond. Either if they want to buy the bond, that will be very high risk, right? Yeah. So they have to offer very, very high return.
Okay, thank you, doctor.
No problem. Yeah, again, because it depends on the risk that you may take from the investment. So be careful when you decide on the investment. So you can always go to, I think now we have many database, right, to tell you what is the average as a benchmark for your investment. Yeah, if someone guaranteed you return for investment, it should not be more than 2% return, right, a year. Yeah. If they say that you can get 30% is guaranteed, no, there's something wrong with that. Because if there is 30% guaranteed, no, I mean, they will not offer it to you, right? Yeah. They will just grab all the opportunity for themselves. Okay. Unless you are entrepreneur, entrepreneur is different. Entrepreneur is something like you find a unique idea and it's pretty risky, right? But you know that you have confidence because you yourself can actually decide on the risk and then the secret and everything, right? So that can be more than probably 100% because you know everything. Yeah. What I said is if someone come to you and want to promise you, okay, this is very uh, high return, right? So be careful. Make more investigation about the investment. Okay. Any other question?
Doctor.
Yes.
So for the green table, right, the 5.86%,
Uh-huh.
is it also consider the amount of percentage that we can lose money?
No, yeah, I mean, I mean, like, it's a compensation because you willing to give your money to the company give you extra 5.8% a year than the government to compensate because I think you willing to take the risk. Now we give you more, but you may lose all your money. Remember, it's like this: if you lend me money for investment, right? So I use your money to do the business, and suddenly I fall into bankruptcy and my asset is zero. I cannot pay you anything, right? Yeah. So you may lose all your investment. Yeah. That's the risk that you take from the investment that you choose. Yeah.
Okay,
Is it
Doctor.
okay?
Thank you.
That's mean by 5.8% is the compensation, yeah, for risk that you take. But in terms of losing the money, you may lose all of your money. Yeah. Compared to investment grade, also you may lose all of your money, but the chance is lower. The speculative one, you may also lose your money, and the chance is higher. But you can, there is also risk that you will get back all your money. Yeah. That's mean by risk. It's uncertainty. Yeah. When the uncertainty is higher, so risk is higher. Okay, thank you. Any other questions? So these are the risks that been compensated to investor. So I think all of you should not fall into financial scam or like fraudulent investment scheme, right? Because especially when they ask you to invest and give you very high return, which is you have to be very careful. And also you can advise your family members about it to give more awareness. Okay, like default risk, like what I mentioned, if the company is high risk to default, you'll be compensated with higher risk premium. Maturity risk, the longer investment, they will give higher maturity risk premium. When there's so many contracts between you and the borrower, and then you'll be compensated with a higher contractual provision risk. So that's the term structure. And then we're gonna actually talk about the corporate bond. Do we need to take a break, or we can continue? Can continue, everyone? Or you want to take 5-minute break?
Continue.
Okay, let's continue. Thank you. Corporate bond. So after we understand the concept of interest rate, now we want to actually talk about the corporate bond. Because remember, corporate bond is when the company issue bond certificate and the investor will give money to the company. Again, it related to the financial system, the deficit and the surplus. Company is a deficit who need capital, and then the investors are the surplus. So how to protect the right of these two parties is through the legal documentation. So we're going to talk about legal aspect of corporate bond, and after that the features, the cost, the conversion features, the callable features, the bond yields, and the bond prices. First, the corporate bond. A bond is a long-term debt instrument indicating that a corporation has borrowed a certain amount of money and promised to repay it in the future under clearly defined terms. And the bond coupon interest rate is the percentage of a bond par value that will be paid annually, typically in 2 equal semi-annual payments as interest. And the bond par value or face value is the amount borrowed by the company and the amount owed to the bondholders on the maturity date. The bond maturity date is the time at which a bond becomes due and the principal must be repaid. So it's not the same with the loan amortization. Remember, when we discuss loan amortization in time value of money, when you borrow money, you have to pay equal installment, right? Until you finish paying the interest and the principal. All the time you pay the same amount. Bond is different. It's something like, okay, if you are a bond investor and then the company want to borrow 1,000 from you. Okay, now today you give the company 1,000. If the company say that I will give you the coupon interest of 10%. So 10% from 1,000 is 100. So the company will pay you 100. Say like the bond is for 10 years. Okay. The first year the company will pay 100 only. The second year 100 until third, fourth, until 10 years, right? On year 10, the company will pay you 100 plus the company will return back the principal to you. Okay, that's how the bond works. So the bond is the company borrow the money now and then they pay you the coupon interest. Coupon interest in the dollars or the ringgit term. They pay you every period. If annually, they will pay you 100. If semi-annually, they will pay you $50 in the first 6 months and $50 in the next 6 months. Right? Yeah. So every 6 months. We have learned in time value of money about semi-annual, right? Compounding interest. And then par value is the value that the company will pay you back on the maturity date. Remember I told you, you give 1,000, the company pay 100, 50, 50, 50, yeah, for 10 years or 20 period every 6 months. And then on the maturity date, the company will pay the last $50 plus 1,000. That's the par value or face value. The maturity date, yeah, it depends. Just now we see that the bond range between the short term to the long term one, up until 30 years, right? That's the maturity date. So as I mentioned to you, to protect the right between the issuer and the investors, so there must be a legal documentation. We call it as a bond indenture. It's a legal document. Before you can receive money. So who regulate this? The Security Commission, right? So there is a standard debt provision, the items, and then the restrictive covenants. Like what do and don'ts for the company. Yeah. When you give the money to the investors, to the company, there is a things that the company have to follow. This is the example. Yeah. I think we're not going to discuss this further. Only later if you take any, I think fixed income paper or course, you can learn more about it, right? What's meant by restrictive covenant? Why they said that the company need to actually put a minimum level of liquidity, because they have to pay the interest every period, right? Yeah. To make sure that the company did not fall into bankruptcy, because if bankrupt, you may lose all your investment. Yeah. So you see, in general, violation of restrictive covenant give bondholder the right to demand immediate repayment. For example, like if they know that the company violate the condition, so you can immediately ask the company to pay back your money. Because if they continue doing that, then you may lose all your investment with them. And after that, subordination. So there is a rank. When you invest in bond, there are many different rank of bond. Senior bond, junior bond, or something like that. What's mean by senior? Whatever happened, the company have to pay the senior bondholder first. Then only after that, the company will pay the junior bondholders the coupon interest and the principal. Since the senior bondholders or senior debt received the money earlier, so therefore the return for the senior is lower because lower risk, right? The junior one will get paid later. Because of that, the junior bond will get higher return. Yeah, that means subordination. Yeah. Okay, that's subordination. If it's still not clear, please ask. And after that, the sinking fund requirement. Sinking fund is something like this. Okay, just now I give you example, $1,000. All right, yeah, 1,000 is small amount. So now we assume 1,000 million or 1 billion. You give the company 1 billion and the company will pay you 10% every year. So at the end of year 1, the company will pay you 100 million. Second year, 100 million. Third year, 100 until year 10. 100 million plus, what is the principal? 1 billion. So 1.1 billion in year 10. So how the company get the money? Immediately the company have to pay 1.1 billion on year 10. So therefore the company have to save money from the very first year. So whatever they have in the very first year, they have to allocate some. Although they need to pay in year 10, but they need to start saving the money from year 1 onwards. So on the year 10, the company will have enough cash to pay back the principal. So the money the company allocate will be put under the sinking fund. So sinking fund requirement means that the company have to allocate some money from the very first year to make sure that they are capable to return back the money on year 10. That's meant by sinking fund. And there is also a trustee, yeah, that actually monitor the company performance to make sure that they do what they promise, to not violate any things that have been agreed upon. That's a trustee. Okay, any question?
Doctor, can
Yes.
doctor explain again the subordination?
Subordination. Okay, like you, Ikmal, you buy my bond and you are senior bond holders, right? And then your friend buy also my bond, but they are junior. So like this, if suddenly I fall into bankruptcy, right? So I cannot, I have very little money to pay both of you. Yeah. So since the requirement said that you are senior, Ikmal, so I will pay you first. So all the money that I owe you, whatever left, I will pay your friend because your friend is junior. Yeah.
Oh,
Yeah.
okay.
So mean your friend face higher risk investment than you, but your friend will get higher return from the investment than you, because to compensate, you see the risk premium part, your friend, although it's the same company, but you buy the senior bond, your friend buy the junior one, right? Yeah. So that's the difference. Yeah, okay, Ikmal?
Okay, doctor. Thank you.
Okay, Fairuz, any question? Yeah.
Doctor, I have three questions.
Yes.
So the first one is bond. As you
Uh-huh.
said right now, the long term is goes to 30 years, and for the
Uh,
short term bond,
uh,
what is the minimum year for bond? Is it 1 year
I
also?
think 2 years. Yeah. The 1 year we
2 years.
call it under money market. Also we call bond or bills, right? Yeah. So that's for 1 year. They have 3 months treasury bills, 6 month treasury bills, 9 month treasury bills, and then 1 year treasury bills. That is a short term. I think normally 2 years onward we call it as uh, the medium term and the long term. Yeah. So, is it okay?
So you mean the minimum bonds for short term is 2 years.
Yeah, I think some people call the short term one also government bond, but we call it as a bills, right? But it doesn't matter. Bond is a debt instrument. If it is less than 1 year, it's a short term. Yeah, it's a more than 1 year or 2 years, we call it as a long term. Yeah. So normally more lah, like more than 2 years lah, normally the bond. Is it okay?
Okay.
Okay, and then
My
your
second
second?
question is, um, from the previous said that for the speculative company that have financial problem, it will give a high return with
Uh,
the high risk.
uh-huh.
Okay, but then how to differentiate company that have financial problem and the company that want to
Oh,
go to bankrupt?
yeah, it's a rating agency. I think later on we talk about who there is a rating agency who provide rating like this to the company. Because the company have to pay when they want to issue bond, right? So they will get the rating. So the rating agency will evaluate their financial condition and financial performance. So then they will announce whether they are at triple A, which is very high. So mean the risk premium will be the lowest, or the D or C. So that one is the one with the lowest grade or low grade, a speculative bond, right? And then they will give you high risk premium. So that's the rating agency who decide. Yeah, like us, we don't know, right? So we need to use the expertise. Like auditors actually audit the company financial statement, and this rating agency will evaluate the ability of the company to pay back your money. Yeah. Is it okay?
Okay, thank you,
The third.
doctor. My last question is,
Mm-hmm.
for the ordination, how to
Mm-hmm.
differentiate the senior and junior bondholder? Is it from based on year?
No, no, no. It's a
No.
company. The company, the company will decide uh, whether you, for example, like okay, the company also. This is like marketing, right? I mean, if you want to offer all uh, what I call all junior, I mean, this is very expensive for the company. So the company will tell you, okay, if you buy this, I will give you 5% return. Yeah. But this is the senior bond. Anything happen, I will pay you first. And suddenly, the company also want to issue another bond. Okay, now you are a junior bond because you will get paid after I pay the senior, I will pay you higher interest rate. Now I pay you 6.5%, 1.5% more than the senior. So then you can decide whether you want to invest in a senior bond or you want to invest in a junior bond. Yeah. So that's your decision. So the company will let you know, yeah, which one will get paid first. Oh, is it okay?
Oh, okay. Now I understand. Thank you, doctor.
No problem. Any other question? Okay. No question, eh? Okay, now, in general, the longer bond maturity with the higher interest rate, right? And then the larger the size of the offering, the lower will be the cost because of the economy of scales. Yeah. And then the higher the default risk, the higher the cost to issue because the company have to pay more risk premium. More risk premium mean higher cost for the company. Yeah. If you're financially bad, you see that, yeah, very difficult, right? The company is facing the financial problem, and then they have to pay more interest to the investors because of there is a chance that they may default. Yeah. And finally, the cost of money in the capital market is the basis from determine the bond coupon interest rate. Yeah. So yeah, this is based on the demand and supply. I mean, what is the interest rate, and that will be based on to decide what will be the interest rate for the company bond. Because remember, the risk free plus the risk premium. And then for bond, you also have to understand the conversion features and call features. We call it the convertible bond and callable bond. Convertible bond give the investors opportunity to convert the bond into equity, stock, after maturity, on the maturity date, right? So who you think that have advantage for the convertible bond? The investors or the issuer?
Investor.
Yes, investor will get advantage over issuer here because the investor will receive option to either get back the principal or convert the bond into equity. So what will be the results? Yeah, the bond price will be the required return will be higher or lower for convertible bond?
Lower.
Lower, yes, yeah, Pak Ziwe. Because of, you have that option, it's lower risk, right? So therefore, remember sometime when the company don't want to pay very high cost or very high return or interest to the investors, they may offer the investor to convert the bond into stock at maturity date. So then they can pay at lower price. That's the conversion features. The second one is the callable features, where the company will have the opportunity to call the bond, to retire the bond before the maturity. For example, like the bond is for 10 years, says like on the year 5, the company has option to terminate the bond before the maturity. So in this case, who has advantage, the company or the investor?
Company.
The company. So what will happen to the required return, or the interest rate will be higher or lower?
Lower.
No, it will be higher because it's riskier for the investors, right? Because you want to invest for 10 years and suddenly the company can actually terminate the bond in year 5. So to the investor disadvantage. So you'll be compensated with a higher risk premium. So but now I think all bond are callable bond where they give advantage to the issuer. Yeah. But normally because of to compensate the investors, the company will pay the call premium, some premium to the investors if they decide to actually call the bond before the maturity. Yeah. So when do you think that the company will call the bond? When the interest rate increase or when interest rate decrease? Yeah.
Increase.
increase. Why?
The cost of the company to pay the interest, the coupon payment will be low.
The coupon payment is fixed, right? Remember, just now I give you example. If you give 1,000 to the company will just pay 100, 100, 100 until maturity, right? So no effect on the coupon interest payment. The effect will be the total cost lah, the effective cost. Yeah. So it's actually when the interest rate drop, yeah, the company will call the bond. Why? Because if the company continue paying the 100, 100, 100, that means you have to pay 10%, right? For the money you borrow. And suddenly at the market, the interest rate is only 7%. If you continue paying 10%, so you lose, right? From the company perspective. So you better retire the bond and then refinance or issue a new bond with the 7% only. So that's why the company will call the bond when the interest rate drop, because it's cheaper for them to retire the bond than issue a new bond. Yeah, that's basically the concept. Yeah. Okay, any question? Yes, Chong
I
Lizin.
still confusing because just now you say if the interest rate is dropped, then the company will call back the bond.
bond.
Is it? But logically, if the interest rate is low, that means the interest rate need to pay by the company will be lower. So the cost will be lower, right? Then why they want to call back the
Yeah,
bond?
just imagine the example I give you just now. Like Chong Lizin, for example, like, okay, I give you 1,000, and then you are the company, and you pay me 100, 100 every year, right? For 10 years. On the maturity, you will give me back my money 1,000. So I will get 10% return. Your cost is 10% because you had to give me 10%, right? Yeah. Because at that time, the interest rate is 10%. Just imagine you continue paying me 10%, and suddenly you realize that the interest rate dropped in the market to 7% because you borrow money from me, right? Okay. Now, if 7%, if you continue paying me 100, 100, 100 until maturity, you lose or you win as a company.
Oh, okay. So that is it. The interest rate is the interest rate in the market is the cost for the company to borrow the money.
Yeah.
Oh,
Yeah.
okay,
Mean
okay.
like if you continue paying me 100, so that means 10% cost for you, right? But if you stop paying me 100, you just return back the money, so you can issue a new bond. You say that, okay, now I want to issue new bond. You will get 1,000, but you only pay 70 ringgit. Yeah. Because now the interest rate in the market is only 7%. Yeah, you should not continue paying 100. Yeah, because it's costly. Okay, any other question? Yeah, how about the principal? You still have to pay the principal 1,000 even after you terminate. Yeah. So when you terminate, the principal is always your obligation to pay because that's the money that you borrow, right? Yeah, the par value. The difference is only the coupon interest and the interest that you pay to your investors. Okay.
Doctor, so the call price will usually be higher because they issued prior to the maturity date.
What?
Will the issuer need to pay higher price than the issued price because they called
for
earlier?
the callable bond?
Ah.
Yeah, I mean normally the callable bond is riskier for the investors, right? Yeah, Lim Xiao Yin. So it's riskier. So normally, if you have option, for example, like one is callable bond, one is not. Yeah, the callable one should give higher return to the investors because there is a risk that the company will call the bond before the maturity, and the company will only call the bond to their advantage, not to the investor advantage, right? Yeah. Because for example, like if the interest rate is 7% drop in the market, if the company continue paying you 100, so that's good for you, because in the market only 7%, but you get 100. Yeah, that's better to continue. But the company don't want that to happen. Is it okay, Lim?
Yeah, understood. Okay.
Okay. Thank you for your question. Any other question?
Doctor, I want to confirm something. If the interest rate in market is dropped, that means the cost for company to borrow the money will be lower, right?
If they retire the bond, yes.
Okay. Yep.
From 10
Thank you,
becomes 7% only. Okay, Noreen, you want to ask question or?
No. Sorry.
Okay, any other question? Yeah. So this is actually the call premium lah. If the company decide to actually pay mature the bond before the maturity, Yeah. And then sometimes, yeah, you see, the company also may actually issue warrant. Warrant is something like right for you to buy the company stock in the future. Yeah, it's basically the company try to their best to pay as low interest rate as possible. So either they offer as a convertible bond, or they issue many, kind of like you do marketing lah. If you want to sell product, you said that okay, you get a free gift, and then you as investors have to evaluate whether the free gift is worth or not, right? Like in this case, they give you warrant. Warrant is something like right to buy shares in the future. Yeah. So when they offer you the warrant, they will pay you lower interest. Yeah. So that's also another thing. And the bond yield, yeah. Yield is a return from bond investment. The current yield is the immediate return that you may get from bond investment. Yield to maturity is the return if you hold the bond until maturity. And yield to call if the company called the bond before the maturity. So this is just the term, right? Yeah. So for this, I think you can read by yourself. This is an example on how the bond are quoted, right? Yeah. The price, the maturity, the yield, and the coupon. You see, the coupon and the yield are not the same. We're going to talk later after this from the bond valuation. So as I mentioned just now, these are the rating. So the international bodies like Moody's and Standard and Poor provide rating for company when they issue bond, especially when it's an international bond, right? So all bond, because in order to get investors, you have to get the rating. And the reliable rating agency only, then I think people will trust the rate given to them. So in Malaysia also we have our RAM, the rating agency of Malaysia. Yeah, in terms of the classification is about the same, but in terms of calculation will be different, because like Malaysian level, they may give AAA for the big Malaysian company like Samdabi, for example, right? But when Samdabi issue bond, they may get AAA from the RAM. But from Moody and Standard & Poor, probably just A. Yeah, because relatively we are much smaller compared to the company in the US. Yeah. So there's also another rating agency like MARC, the Malaysian Rating Corporation Berhad, and a few others as well. So it's kind of like a private company who provide rating, but they get license from the Security Commission. So again, this rating will give you a benchmark, which type of bond that you want to put your money in. Yeah, if you want to put on the high risk bond, yeah, you'll be compensated with a high required return. So these are different type of bond that you can read by yourself, right? Yeah. So there's the explanation. So there are many different characteristics or types of bond that you can decide. It's again based on your choice. So it's kind of like food. I mean, like you can choose many different type of food to eat, right? Yeah. And there is always a good and bad in it. So you have to decide on which appetite that you have. So then you can choose which type of investment that you prefer based on your risk preference and return preference. And there's also international bond. Remember, the international company, for example, like US firm come to Malaysia, issue bond in US dollar. We call it Euro bond. Yeah. It's not only European bond, right? A Euro bond is the international company issue bond in other than the local currency. However, if the US company come to Malaysia, issue bond in Malaysian ringgit, we call it as a foreign bond. Yeah. So that's the difference between Euro bond and foreign bond. So that's basically the corporate bond. So you need to take a break or we can continue with the bond valuation. Yeah. Class.
I think we can have a break.
Okay. Everyone agree to have 5-minute break?
Yes.
Refresh.
Okay. Yeah. Okay, we take 5-minute break before we continue with the. We come back at what time? 4:28 lah. 4:28. Okay. See you after 5 minutes. Sorry, everyone. Yeah. Okay, got a few questions over here. Doctor, I have a question. Does it mean that after the company call the bond, the old bond will cancel and the principal amount will pay after terminate it, or wait until the maturity? No, they have to pay immediately when they call the bond. So they have to return back the principal. Yeah. Because if you still want to invest in the company, they will pay you just 7%, mean lower. Yeah. So that's the thing. That's why they want to call the bond. And then Chong Lizin, the one from Park Ziwei, and then Chong Lizin is, Doctor, I still thinking if the interest rate for company to borrow is decreased, even the bond interest rate is still 10% for the bond holder, I think the company will still benefit. So the company should not recall the bond, right? No, if they think they will benefit, they will not call. But if they know that they can find the normally how to benefit, right? If you continue paying 100 ringgit, so mean you lose because by right you can only pay just 70 ringgit if you borrow from someone else in the market. Yeah. So normally they will only terminate for their benefit. Yeah. So how to benefit if you continue paying 10% when the interest rate is only 7%? So
Oh,
no.
doctor, is it if like that? The company will be better to borrow from someone else compared to
Yeah.
issue the bond.
Yeah.
Oh, okay.
Uh,
Now I understood. Thank you, doctor.
okay. Uh, okay. Any other question? So that's basically the basic concept, lah. I mean, kind of like refinancing, right? Because you think that no, it's not very good paying, I think 10%. So let's actually just call the bond, pay back the principal, and then pay the compensation, and then we issue a new one. Yeah, they will calculate overall whether it's benefit or lose for them. Yeah. If probably only 1 year left, they will not call the bond. But if it's still like long way to go, yeah, if you know that the interest rate will go down in the future, right, will decrease continuously, consistently, you definitely will call the bond. Okay, valuation fundamentals is basically very easy, simple. Why? Because it's same with the time value of money. Yeah, because after you know time value of money, this one should not be an issue. Because the only problem if you don't understand the time value of money and you pretend that you understand, especially during the tutorial, right? Because you give me the answer and you don't even know what actually the answer and how to derive that particular answer. It shows that you don't understand. Yeah. Yeah, actually, I really hope that as a student, our attitude will not be the same, right? We should be a benchmark, yeah, because we are the best university in Malaysia. So once you get the opportunity to come and join the university, please actually grab the opportunity as much as possible. Yeah, try to change your attitude, yeah, because it's pretty normal for the teenagers, right, especially at the university level. So you take it for granted, yeah, but you see that this is the investment that you should make for your future, yeah, because if you're really serious, yeah, in your university life, yeah, regardless of, yeah, it's not necessary we expect you to be a first class student. I mean that sometimes you understand but you don't get an A, it's better than someone who get an A but you don't understand. Yeah, because the knowledge, yeah, and to appreciate. That's why asking question and try to understand is actually effort that you can make to be a better person. Because we really hope that you can be a good ambassador for the university as the best university in Malaysia. Yeah. So you see that, okay, after you understand the concept of time value of money, then we can apply on the bond valuation. Because remember, in the time value of money, we learn on how to calculate the present value. So similarly for bond, right? Yeah. What we call for the bond is to know the bond value today. Yeah. To know the bond value today is finding the present value. Okay, we have learned on how to find the present value for a single amount, for annuity, and for mixed stream. Yeah. As I mentioned to you just now, when you invest 1,000 today, and you will get 100 for 10 years, all right? And then on the maturity, you will get 1,000 back your principal. So you see, what are the cash flow for your investment? Negative, no, you will get 100, 100, 100 for the next 10 years. That's an annuity, right? You can use the present value for annuity concept to know what is the value of this annuity today. And on the maturity, you will get another 1,000. And then to know the value of 1,000 today, so you can use the present value of a single amount. And N is 10 years, right? And then the risk is depend on what required return that you want from the investment. That's basically the concept of bond. So how to value the bond today. Yeah. So this is an example of how the Celia Sargent want to value three different assets. Yeah. The first one is the perpetuity. And then the second one is the mixed stream. And the third one is a single amount. Yeah. So as you can see, you have to decide on the required return. How much return that you want from the first investment? 12%. If you know the cash flow and you know the required return, you can use the perpetuity formula to know that what you should pay or what is the value of the investment today, 2,500. The second one, we use the net present value or present value of a mixed stream, right? And how much return that you want from this investment? 20%. So you discount all this cash flow to times 0, and then you get 9,262. And the last one, you want 15% return on this particular painting. The value is 85,000 in the next 5 years. So what is the value today? Is 42,245. So this is basically, how do we value something? Yeah. So the bond valuation, stock valuation, will use this concept. We use the present value concept. Why? Because we want to know the value of the investment today. Yeah. So for bond valuation, we need to know what are the cash flow that you will receive from bond investment. Then you discount with the return that you want. Then you get the value today. Very simple because it's related to the time value of money. Yeah. As noted earlier, bonds are the long-term debt instrument used by businesses and government to raise large sums of money, typically from a diverse group of lenders. Most bonds pay interest semi-annually at the stated coupon interest rate, have an initial maturity of 10 to 30 years, and then the par value is 1,000. This is in the US, 1,000 for one bond. But normally people don't buy one single bond, right? Like they buy a huge amount, yeah, because they need to raise the capital. In Malaysia, one value will be very, very high. I think more than 100,000. Yeah. So normally, if you want to invest in bond, you need to go through the like mutual fund or the unit trust. So first they will pull the money and then they will invest. Because for single investors will be very difficult because the one single value will be very high in Malaysia. And normally they pay the interest semi-annually. For example, like if they want to give you 100, they will pay 6 months $50 and another 6 months $50 semi-annually. This also we have learned when the compounding interest rate more than once in a year, right? So you see that the bond has two parts. The first one is the annuity. The second one is a single amount. Annuity means the coupon interest that you receive. The single amount is on the maturity date, you will get back your principal. Then you have to find the present value of all these two cash flows. Okay, take this very simple example. 10% coupon interest rate. 10 years bond, 1,000 par value. Okay, remember again, I mentioned to you, coupon interest is always in dollars or in ringgit. Like in this case, you have to convert the coupon interest to dollars term. 10% from 1,000 is 100. You see, the coupon interest is 1,000. It should be PMT lah. RD, the cost, this is the return that you want. You see, the required return is equal to the bond coupon interest rate. So the coupon is 10%, the required return is also 10% in this case, because most of the time required return and coupon are not the same. So first, always know how to differentiate between coupon and the interest rate or the required return. Yeah. M, on the maturity date, you will get back your principal, and is 10 years. So as you can see, these are your cash flow for your bond investment, for this particular bond investment. You want 10% return, and then you will get 10% coupon, which is 100. And then on the maturity, you will get back your principal 1000. So if you discount all of them back to time zero, the annuity value will be 614 and 46. The single amount value will be 385 and 54. When you total them, you will get 1000. You see? N equal to 10, interest equal to 10, PMT, coupon is 100, future value on the maturity is 1000, and then you will get present value. The price of the bond should be 1000 because the coupon and the interest rate are the same. Yeah. So in practice, you see, the value of the bond are rarely equal to the par value. Remember, par value is the FV, right? Yeah. Par value is FV, future value. So whenever the required return bond differed from the coupon, so the par value and the bond price will be different. What are the things that actually influence the difference of the required return than the coupon? You see, again, we go back to the interest rate, the nominal one that we discussed. The first one is the real, the second one is inflation. These two actually are economic condition. Changes in the economic condition will change the real and the inflation. The second one, the risk of the company, right? The company risk change and then will change the risk premium. Therefore, it will change the required return, the R1 of the bond. Yeah. So that's basically increases in the basic cost of long-term fund or in risk will raise the required return, decrease in the cost of fund or in risk will lower the return. So decrease in real or inflation will decrease the return, and decrease in the risk premium will also decrease. So any decrease in all these factors will decrease the required return. Any increase in all these three factors will increase the required return. Yeah. Okay, I want to show you here. You see that the coupon from the very first example is 10%, which is the PMT. The coupon payment, the annuity is always 100. However, the required return may change. Remember, these are the factors that may change the required return, the economic condition and the firm risk. So if the risk increase, or the required increase from 10 to 12%, what will happen to the bond value? The bond value will drop to 887, and the bond will be sold at discount. If the required return drop to 8%, the bond value will increase to 1,134. And the bond will be sold at premium. Just imagine, here we discount all this 100, 100 and 1,000 with 10%. If you discount with 12%, the amount at the present value will be lower than 1,000. If you discount with only 8%, the amount will be more than 1,000. This is how we decide on the bond price. Yeah. So that's basically the concept. So up until here, any question? Yeah. So this you have to understand, right? Yeah. Before we come to the calculation part, so you have to understand about the relationship between the coupon and the required return, and then what determine the required return. Yeah. So like in this case, when you require 12% return, the company will pay you only 100, 100, 100. On the maturity, the company will give you another 1,000. In order to make your investment 12%, you just pay 887 now, today. All right? You pay 887 today, you will get 100, 100 for 10 years plus 1,000 on the maturity date. That will make your investment 12% return. Or if you just want 8% because the risk has dropped, all right? So you have to pay more than 1,000 today, 1,134 and 20 cents. You pay for the bond today, but you only get 1,100, 100, and then 1,000 on the maturity date. You have to pay more, right? So because the return that you want is only 8%. Yeah. So the bond will be sold at premium. Yeah. Okay, any question?
Doctor. So this table, right?
Okay.
It tells from the perspective of investor, right?
Yeah, somehow investors lah, but actually it's the same lah. I mean, like
Oh,
just a mirror, right?
okay.
When the investor pay 887, mean the company receive the 887.
Okay, doctor.
Yeah.
Thank
When
you.
the company pay 100, so the investor receive 100. Yeah, something like that. Yeah. Is it okay, Ikmal?
Yes, doctor.
Okay. Okay, Chong Lizin, understanding is far more important than grade. Yes, true. Pak Ziwei, doctor, which is better? No, yeah, it's not better or worse, right? Yeah, it is. I think it depends on the rate at the market. Yeah, if the market rate is 12%, so you just have to pay 887 and then you get 10% coupon, right? Yeah. Otherwise, if you want to pay 1,000, the company have to pay 12% coupon. I mean, 120, 120, and 120. So they're all the same thing. It's just like the required return will be decided by all the factors that we mentioned earlier. This, yeah. So the market will decide on what rate. Yeah. And the company will decide on how much they want to pay. If they said they want to pay only 10%, right? So if the return is 12% in the market, right? Then the company just willing to pay 100 every year. So that means they only get much less than 1,887 today. When the investors buy the bond, investors only pay 887. Yeah. But they have to pay 1,000 on the maturity plus 100 every year to make sure that the investor will get 12%. So that's basically the concept. Yeah. If they're all actually the same risk, right? So they all should be the same. Yeah. If A, B, and C, same risk investment. So they should all give you 12% return. Whether they want to actually ask you to pay 1,000 now and pay 120, or they just ask you to pay 887 and they pay you 100. So actually you should be indifferent between the two. Is it okay, Pak Ziwi? Or still not clear?
Yes, I'm clear now. Thank
Okay.
you, doctor.
Okay, any other question?
Doctor.
Yes.
So for the previous slide, I mean the
Okay,
calculation.
this one.
Previous slide.
Okay, which one? This one.
Yes.
Okay.
When I key in the formula, the final answer negative.
Yeah, of course. Because one is when you investors, right? When you give 1,000 to the company, is a cash outflow. Later, when you receive 100, positive. And then
Also the negative means
cash outflow.
Oh, okay.
But if you put PMT negative or FV negative, you will get present value positive because that's from the company perspective. Because you receive the present value cash positive inflow, later you have to pay the PMT, and then on the maturity you have to pay 1,000. So PMT and FV will be negative. So it depends. That's a financial calculator only. As normal calculation, you'll get positive.
Okay, thank you, doctor.
No problem. Okay, thank you, Ikmal. Any other question? So this is how we calculate, right? Use your financial calculator. Now we just change I. Previous one is 10 and 10%, and now either 12 or 8. Then it changed the bond price. Yeah. So you see that the investors will feel scared of increase in the interest rate. And the company scared that it drop in the interest rate because the payment is fixed, right? So you see that if the interest rate increase, the investor lose, right? Because they only get 10% from the company. So that's why the bond have negative relationship with the interest rate. So before we continue, okay, let's attempt this question. Delima Transport Company has an issue of interest rate outstanding. Issue of 1,000 ringgit par value bond with 14% coupon interest. The issue pays interest semi-annually and 10 years remaining to its maturity date. And then the bond has similar risks are currently selling to yield at 12%. What is the value? Okay, what is the rules? If the coupon is greater than the yield, at discount or at a premium class, the bond price.
Premium.
Premium, right? So your answer should be more than 1,000. So what is the answer? Where's my financial calculator? Oh, here. So what's the answer? 1,000 is the future value. Remember, it is semi-annually. So what's the answer, class? Apply your time value of money concept. Semi-annually, PMT divide by 2 and multiply with 2, and then interest rate divide by 2, right? And then you should get more than 1,000 because the yield is lower than the coupon. Now, what's the answer? Anyone? Class. Any answer? Yeah, Chia Zichen, 114.70. Yes, I think that's the answer, right? This 114.70. So FV is 1,000. PMT is 140. Remember, coupon is always in ringgit or dollar term. 140 ringgit, right? Because this is semi-annually, 70 ringgit. And 10 years multiply with 2 and then 20. I is 12% divided by 2, 6%. And the present value is 114.70. That is the present value. Any question? This is how we ask you to calculate the bond value, right? Very simple. We just apply the time value of money concept. Everyone okay? So bond value has negative relationship with the required return. The higher the required return, the lower the bond value. The lower the required return, the higher the bond value. You see, when the required return increase, the bond value will drop. So interest rate risk is a chance that interest rate will change and thereby change the required return of the bond. Rising rate which result in decreased bond value are of the greatest concern because investors will suffer losses when the interest rate increase because the bond value will drop. The shorter the amount of time until a bond maturity, the less responsive is its market value to a given chance in the required return. And then again, you see, the shorter the period of the bond, the lower the risk. Because remember, when the bond is closer to the maturity, it will approach the par value. So the fluctuation of the bond price will be smaller, less risk, right? So the longer the bond maturity, so the higher the risk. So the concept here means the bond will converge at the par value when it become closer and closer to the maturity. You see that 8% and 12%, the difference for 1 year bond are very small compared to the 10 years bond, right? The difference are huge between the 8% bond and 12% bond. Okay, now we might come to the yield to maturity, the final part of the discussion. I hope that we still have time. Still have some time. The yield to maturity is the return of the bond. Is the rate of return that investors earn if they buy a bond at a specific price and hold until maturity. provided that you hold the bond until maturity. This is your yearly return, right? Yeah. Assume that the issuer make all scheduled interest and principal payment as promised. It is essentially the bond internal rate of return based on the current price. Note that the yield to maturity will only be equal if the bond is selling for its face value of 1,000 and that the rate will be the same as the bond coupon rate. So the yield only the same with the coupon when the price are the same, right? Yeah. The bond will be traded at premium. I think we have discussed when the coupon rate is higher than the prevailing interest rate, as the example just now. And this is because investor want higher yield and will pay more for it. For discount bond trading below its par value coupon rate prevailing the interest rate. If the coupon rate is less than interest rate, so it will be sold at discount. Yeah. So this is how we calculate the yield to maturity or return of the bond. This we have discussed in time value of money on how to find the return for investment. Like in this case, n equal to 10, the present value, you see, one of them must be negative, right? In this case, we put the negative sign for present value. And then 100 for PMT and 1000 for future value. So the coupon is 10%, but the bond price is at premium. Remember what is the rule? When the bond is sold at premium, so the rate will be lower than the coupon. Like in this case, is 8.766%. Yeah. Because at premium, the rate will be lower than the coupon. So this is an example when the bond is paid semi-annually. You have to divide the payment by 2 and you have to multiply with 2 and then the required return divide by 2. I think we have calculated just now using the example. This is another example given to you. How do you calculate the bond when it is semi-annually? Yeah. And 10 multiplied 2, 12 divided by 2, 100 divided by 2, and then you get the bond price. We have calculated in our example just now. Okay, now calculate the yield to maturity. If you use formula, this is quite challenging, right? Yeah. It will take some time, but you still can solve because this is only one unknown. Because you don't know what is the rate of return. Yeah. The RD. Everything else you know. Yeah. So in this case, the coupon is 12%. Again, semi-annually. 3 years remaining to maturity. And the current price is 940. Remember, this is at discount. What is the rule? The interest rate or the yield should be higher or lower than 12%. Yeah. Class. Higher or lower than 12%? The answer. Oh, tired already. Yeah, we only have 2 minutes left. Higher or lower? Remember the rules? Yeah. Higher. Yeah. So then your answer should be more than 12%. Yes. If the bond is sold at discount, so it should be higher than 12%. So what is the answer, class? Now, apply your time value of money concept. You know the PMT, you know the PV, you know the FV is 1000. In this case, yeah, because they give you 940, so we assume that the par value is 1000. If they give you the value is 94, the par value will be 100. Yeah, so that's the assumption that we should make for bond valuation. If they give you 1100 something, so the par value is still 1000. Yeah, it's around that price. So FV is 1000, right? And you know the FV, you know the PV. Remember, if you use your financial calculator, don't forget to put minus sign, right? And then this is semi-annually. So what is the yield to maturity? Class, anyone please try? The last minute, yeah. Tan Sitting. What is the answer? 14.54. Yes, I think that should be the answer, right? Thank you. Yeah, 14.54%. You see, after you understand, very easy and very simple. Future value 1000, present value is 940, negative. PMT, 12% is 120, but it is semi-annually 60, right? And it's 3 years remaining. And then if it is semi-annually, you have multiplied with 2. When you press I, you get 7.2693%. Remember, this is interest rate for 6 months. You have to multiply with 2, and then you get 14.54%. Okay, any question?
Doctor,
Yes.
can I know why just now you said like it is disadvantageous to investors when interest rate increase?
Yeah, because your investment will drop, right? Because for example, like, okay, originally, thank you for your question, Angita. Just imagine this one, right? If for example, like you invest at 1000 now, because at that time the required return is only 10%, and then you get 10% coupon interest, right? And suddenly the interest rate increase and you want to sell your bond to someone else, right? So what is the price? When the interest rate increased to 12%, the price dropped to 887, right? So you lose from your investment because you invest at 1000 and then the value of the bond dropped to 887. And the opposite, when the price of the bond, the required return drop, right? So the price of the bond value increase. Because when you invest in the bond, you want the value to be higher. Why this happen? Because remember, you get fixed payment. Yeah, the coupon payment will be fixed until the maturity, regardless of the changes of the interest rate. So since the payment is fixed, so what change is the value of the bond. Yeah, so you lose. For example, like if you already give the money 1000 to the company, you only get 10%, and suddenly in the outside market, the investment give you 12%, so you lose. Yeah, so that's the meaning. Is it okay, Angita? Agnita?
Yeah, thank you, doctor.
No problem. Okay, any other question? So I hope that you know how to calculate the yield to maturity. This is an example. You see, very simple calculation. One, value the bond. Second, yield to maturity. Even with this, many did mistake in the exam. I don't understand. Why so difficult, right? Probably because you don't put effort to understand. Yeah. It's very simple calculation. So this is the formula, and this is a summary of our lecture today. Remember, today we learn about the bond valuation. Is how to value your long-term liability to make sure that when we pay or when we invest or when we issue bond, we issue at the theoretical price, the correct price. All right. And the first part of the discussion, we talk about the interest rate that play a big influence on the bond valuation. The second part, we talk about corporate bond, and then what are the features, and then how to value the bond as well as to find return of the bond. Okay, I think that's all for today. Any question before we end our session? Yeah. So next week will be the last week class with me, all right? And then after that, Dr. Fauzi will take over. And then remember, you will have your midterm on week 8. Yeah. I think I'll just send the notice. I mean at 3 p.m. If you have class, please request because it's on Friday, right? Yeah. Request to have the exemption just for 1 hour to attend the midterm test. Any question? Yeah, it's already exceeded the time. Sorry for that. So if no question, yeah, please.
I want to ask about the yield to maturity formula.
Shazwana.
Is it the par value divided by current price, power of one over the period?
Which one?
I found this formula online, but I tried to calculate, but I didn't get the 14.54.
Yeah, if more or less the same is acceptable because we can use the approximate formula. that we will learn in the cost of capital letter, right? I think they will teach you on how to approximate the, if you refer to your lecture 9, if I'm not mistaken, there is the approximation formula where you can use that to actually estimate the yield to maturity. Yeah.
Oh,
So
okay, thank you.
you
Thank
get
you, Dr.
around 14%, it will be acceptable.
Okay.
You cannot get accurate lah if you don't use the financial calculator. It's okay, it's acceptable. Okay, Shazwan?
Thank you, Doctor.
No, no problem. Okay, any other question? So if no question, let's end our class today. Thank you everyone for joining the session until this time, and sorry also for taking more time than the expected time. So yeah, for next week, we're going to continue to discuss the stock valuation. I think if you have any question or any issue, you can always let me know. I think wish the Muslim selamat berpuasa and happy Ramadan to everyone. And then for the rest of you, and then have a good day for the rest of the week. And then we see you again next week. Assalamualaikum and good evening. We see you everyone next week. Bye bye.
Thank you, Doctor.
Thank you, Doctor.